For decades, America has appeared financially unbeatable. The system looks strong on the surface. The dollar dominates global trade, used in energy, commodities, and international settlement. American financial markets attract capital from every corner of the world, and U.S. Treasury bonds are still described as risk-free. To most people, this looks like total financial dominance. It looks stable, it looks permanent. But real power is not about appearance. Real power is about vulnerability under pressure. A system is not strong because it is large. It is strong only if it can absorb stress without breaking. History shows that the biggest systems often carry the biggest weak spots, because size creates complexity, and complexity creates dependency. Empires do not collapse when they are obviously weak. They collapse when their systems look the most trusted, the most efficient, and the most expanded. That is when the mechanism is fully built. Expansion requires constant support. Constant support creates reliance, and reliance quietly removes flexibility. At that point, strength becomes exposure. This is where the pattern begins. Expansion creates dependency. Dependency creates leverage, and leverage reveals a weak spot that does not show up in headlines or political speeches. China did not need to attack America to find this weak spot. It did not need confrontation or war. The architecture of the American financial system created it over time. America built it itself. When people hear the phrase weak spot, they usually think about weapons, armies, or advanced technology. They imagine military gaps, cyber attacks, or hardware failures. But that is not where modern power actually breaks. Those are visible threats. Real breakdowns happen in places most people are not trained to look. In the modern world, power breaks at the financial level. It breaks inside the system, not on the battlefield. A financial weak spot is quiet. It does not appear on the evening news. It does not explode or announce itself with alarms. It sits beneath the surface, hidden inside balance sheets, debt structures, and capital flows. A financial weak spot is a point where the system can no longer change direction without pain. It is the moment when every decision carries a cost. Raise rates, and markets break. Cut spending, and growth collapses. Print more money, and the currency weakens. At that point, choices are no longer free. They are forced by the mechanism itself. That is what debt creates. Debt removes flexibility. It locks the system into a narrow path and increases dependency on constant liquidity. And this is where the pressure concentrates. America now carries more debt than any empire in recorded history. That debt is not just a number. It is the financial weak spot that defines the limits of American power. After World War II, the United States did more than rebuild its economy. It designed the global financial system itself. At the center of that system was the dollar. It was not just another currency. It became the base layer for global trade, finance, and settlement. Other countries used dollars to trade oil, food, and raw materials. Central banks around the world held dollars as reserves. International payments moved through U.S. banks. Over time, the dollar became the common language of global finance. If you wanted to trade, invest, or settle accounts, you needed access to the dollar system. This gave America enormous advantages. It could borrow cheaply, because global demand for dollars stayed constant. It could run trade deficits without immediate consequences, because foreign countries recycled dollars back into U.S. assets. It could spend more than it taxed without facing instant collapse. For decades, this looked like absolute financial dominance. But dominance always comes with a cost. To supply the world with enough dollars, America had to print more dollars. To keep growth going, it had to expand debt. To avoid recessions, it had to inject more and more liquidity into the system. Each solution made the system larger, but also more dependent. Over time, the dollar stopped functioning like a normal currency. It became infrastructure. The global economy was built on top of it. An infrastructure cannot simply slow down or reverse without damage. When the system depends on constant expansion, stopping becomes impossible without breaking everything connected to it. Debt always feels painless at the beginning. Governments borrow to fund growth. Central banks support that borrowing by keeping rates low and providing liquidity. Markets rise, asset prices go up. People feel wealthier. The system appears healthy, and the expansion looks controlled. But debt follows one unbreakable rule. It grows faster than income. Over time, interest costs rise, refinancing becomes constant, and more borrowing is required just to keep the system stable. What once fueled growth slowly turns into dependency. When debt reaches a certain level, the system becomes trapped. Options disappear. You cannot raise interest rates without risking financial collapse. You cannot cut government spending without triggering recession. You cannot reduce liquidity without breaking markets that depend on constant support. Every attempted solution creates a larger problem somewhere else. At this stage, the system no longer responds to leadership, policy, or political promises. It responds only to math. Debt dynamics take control. Liquidity becomes mandatory. Expansion becomes permanent. This is the point where flexibility is lost, and the weak spot hardens into structure. America crossed this point years ago. The debt is no longer a tool. It is a constraint. And this is the moment when external observers stop listening to what leaders say and start watching what the system can no longer do. China noticed. China does not think in election cycles. It does not need daily headlines or public approval. Its strategy is not built around short-term politics. It is built around systems. While others focus on speeches and policy announcements, China studies structure, incentives, and long-term mechanisms. Instead of challenging American power directly, China focused on areas that determine how power actually functions. It invested in supply chains, expanded manufacturing, strengthened financial plumbing, and developed its role in global trade settlement. These are not visible moves. They do not look aggressive, but they shape control over time. While America expanded debt, China accumulated production. While America consumed, China built capacity. One system grew larger through borrowing, the other grew stronger through output. This difference matters when pressure arrives. Most importantly, China watched how the dollar system actually worked. Not the speeches, not the slogans, not the political messaging. It studied the mechanism underneath, and what it saw was critical. America cannot tighten policy without pain. It cannot reduce liquidity without risking collapse. It cannot retreat from global commitments without breaking markets that depend on the system. These are not choices. They are constraints. That is not strength. That is exposure. When the trade war began, it looked like direct confrontation. Headlines screamed about tariffs. Politicians used harsh language. Media framed it as a battle between nations. It felt dramatic, urgent, and decisive. But appearances can be deceiving. Behind the scenes, very little actually changed. Supply chains quietly adjusted. Companies found ways to keep goods moving. Capital continued to flow. Financial integration grew stronger, even under the threat of tariffs. The system kept working because money always follows the path of least resistance, not political rhetoric. Even during the trade war, U.S. institutions acted strategically. They expanded operations in China, increased market access, and pushed capital into Chinese assets. This was not a mistake. It was not confusion or it was alignment with the underlying mechanism of the global system. Politics argued loudly. Capital moved silently, and capital always moves toward the future system, not the current one. While headlines capture attention, the real story unfolds in flows, investments, and positioning that most people never see. This is where real influence and long-term advantage reside. You can ignore speeches, you can ignore headlines, you can watch debates, listen to promises, and follow political theater, but none of that shows what is really happening. You cannot ignore capital flows. Money does not lie. It moves silently, steadily, toward opportunity and safety, not according to political schedules or daily announcements. When trillions of dollars move quietly, it signals something far deeper than policy statements or public rhetoric. It reflects the real priorities of the system. China did not need to announce pressure or make threats. It did not need to act aggressively. Instead, it allowed the system to continue expanding while positioning itself inside it. Debt grew. Liquidity increased. Dependency deepened. Every expansion of the American financial machine created more exposure, more reliance on constant support. Each dollar flowing through the system reinforced the weak spot that already existed. America's financial weak spot did not shrink under the trade war or political gestures. It grew. The architecture of dependency, created over decades, became larger and more visible to those who understand the mechanics of global capital. And that is the reality China exploited. This is the new form of conflict. It is not fought with tanks. It is not fought with missiles. The weapon is exposure. Vulnerability in the system replaces open confrontation. The weak spots are financial, structural, and invisible to most observers, but they carry enormous power. If America tries to tighten policy, markets crash. If America loosens, the currency weakens. If America confronts, global systems that depend on constant liquidity and confidence begin to shake. Every move carries risk because the system is stretched to its limits. China does not need to pull a lever to force change. The lever already exists. The mechanism has been built over decades. The global system is balanced delicately on debt, confidence, and constant liquidity. Remove or disrupt any one of these elements, and the entire structure reacts violently. This is not speculation. This is leverage. The pressure is already in place. And the longer it remains unnoticed by the general public, the more effective it becomes. The system reacts according to its own rules, not political rhetoric. This is where the historical pattern becomes clear. Every reserve currency system in history follows the same stages: expansion, overreach, dependency, and finally transfer. These stages are predictable, almost mathematical, and they repeat across centuries, regardless of politics or technology. The transfer stage is never loud or obvious. It does not announce itself with headlines or government statements. It happens quietly, while people argue about policy, while media debates dominate attention. It happens while markets still appear strong. It happens before collapse becomes visible to the general public. China did not need to break the American system. It did not need to challenge it directly. Instead, it positioned itself inside the system, aligning with the flows of capital, production, and influence that define how power actually moves. While most observers focus on confrontation, the real shift occurs in mechanisms, not rhetoric, and the mechanism is now activating. This is not about tomorrow. It is not about panic or reacting to the latest news. It is about direction, understanding where the system is moving and why. The real weak spot in America's power is not China. It is debt, the dependency, the leverage, and the structural pressure built over decades. China simply understands this. The system will continue to operate until it reaches its limits. Liquidity will expand until it loses real meaning. Confidence will hold until it falters. The process is not random, and it does not depend on politics or slogans. It follows a pattern. This is not prediction. It is pattern recognition. The stages of expansion, overreach, dependency, and transfer are already in motion. The only real question is not whether the mechanism completes, but who sees it clearly before it does. Those who understand the system's rules, its architecture, and the flow of capital have the opportunity to act before the completion of the next stage becomes unavoidable.